Hello and welcome to On the Record. I'm Shereen Bhan. My guest today is spearheading a business that has been a clear outperformer in the market. ITC, the stock is up 52% this year, and on the back of strong performance. If you take a look at all of the businesses, the cigarette business, volumes in line with the analyst expectations. If you take a look at the FMCG business, the revenue has shown a beat. Margins, though, have been a tad tepid in comparison to the estimates and expectations. There's been a strong beat on the hotel side as well as the agri-business, and the paper business has shown a strong growth as well. Well, joining me now to talk about where things currently stand and, more importantly, what the road ahead looks like is ITC Sanjiv Puri. Sanjiv, always a pleasure. Many thanks for joining us here on CNBC-TV18 On the Record.
So thank you, Shereen, for having me. It's always a pleasure.
Always good to have you. So let me start by asking you about where things stack up in terms of demand at this point in time. It has been a difficult inflationary environment, but given that you have delivered on expectations, and in fact you have been ahead of expectations as well as far as Q1 is concerned, both in terms of the demand outlook, in terms of inflationary pressure, how does the outlook look?
Well, I think the good sign that we have today is that the economy has really normalized. The recovery has been robust, and the economy is progressive, and that stable environment does well for businesses. So we are continuing to experience strong growth across our business segments. Yes, inflation is a concern, but that's more limited to the consumer side, where we are continuing to see growth. Yes, there is of course a stress that you alluded to in the beginning also as far as margins are concerned. But having said that, let me also say that, despite the severe inflationary pressures, last year we were able to sustain or little bit, in fact, increase margins. And so far we've been able to more or less sustain it through a mix of actions. So yes, that is a monitorable, and we're doing what we can through better assortments, through better management of cost. I think this kind of inflationary pressures also calls upon all of us for more belt tightening than we have ever done in the past. So that's what we are doing. We're looking at what more efficiencies can be brought into the back end and use the pricing lever really as a last resort, because in the inflationary environment, we know the consumer is already hit.
Let's talk about consumer sentiment in a little more detail, Sanjiv. As you pointed out, inflation is biting. What we hear in terms of commentary from other CEOs, leading FMCG companies, is that the urban pockets continue to be stronger in comparison to the rural pockets. There has been a fair degree of downtrading in the market as well. What is the visible indications that you're getting both on urban versus rural demand? Are you starting to see a pickup in rural? And what does that mean in terms of your ability to be able to pass on any future price hikes at this point in time? You said that will be the last resort. Is that something that you're considering today?
So it's like this, that both the trends are visible in the market. There is a strong trend of premiumization. We are also seeing people titrate and go down to lower price packs or really down trade. So both of the trends are visible. We are experiencing overall a strong growth, and what we are also seeing is some green shoots of pickup even in rural. I do believe that given that the inflation is kind of now cooling off, that will lead to some better pricing in subsequent quarters, and that hopefully will help revive demand. I think what we are also very hopeful about is the coming festive season, where we believe that given that it's going to be a normal festive season after a fair bit of time after the pandemic, so we do expect demand to really pick up during that period. Overall, I would say there are green shoots of improvement visible. Inflation is a monitorable, though it's cooling off right now, and second half should be better. Rural economy also should be better, because at an aggregate level, although there have been some restrictions on exports, etc., I think the net costs have also gone up, but realizations are also up. Net, our own assessment, it's a little positive for the rural economy.
Okay, so better second half is what you anticipate, and of course all bets on the festive season that's upcoming. You talked about the export restrictions, and there have been a series of measures that the government has announced across different kinds of commodities. Some outright bans, of course the G2G window has been left open. How has that impacted business for you? What is the export contribution across these commodities for you at this point in time?
All right, okay. Let me first of all, just make a supplementary point on the earlier question. I think we also need to recognize that the base period was not a normal period, and therefore interpretation of data, I think, is best done in a stable environment. So we should really wait for another couple of quarters to interpret, right, on the aggregate performance of the industry. That's one. Okay, coming down to this, you see, there have been in the recent past opportunities that have arisen for exports on account of fundamentally two reasons. One is climate change, wherein competing origin crops have not done well or failed. And two, on account of supply disruptions. First on account of pandemic, and then on account of the geopolitical dynamic. And we've been agile to seize the opportunities, whatever have arisen. However, you see, structurally, what we are focusing on in the agri-business is more on what we're really building is our value-added portfolio. And when I say value-added portfolio, there are two pillars to it. One is through processing, and we have, for example, a plant of spices in Guntur going to be commissioned this year. We have a plant on nicotine and nicotine derivatives. This also will be commissioned this year. We are also adding capacity for our aqua exports. So that's one piece of it. Second is the kind of crops. We are moving more and more towards horticulture. So spices, fruits and vegetables, medicinal and aromatic plants. We had bought a 110-acre plot in Seoul some time back, and where the farmers were trained. Now farmers are growing it. We are buying back, and it's going to be a journey where we continuously go up the value chain and add more and more value to medicinal and aromatic plants, from extracts to more proprietary offers into the market. So that's where structurally we are focused. That is one pillar. The second pillar of growth there, and that's what I'm most excited about, is really ITC Mars. Okay, that's a full stack agri platform. It's a complete solution for the farmer on his mobile, and I'm excited because not only merely because that it's good opportunity for ITC given our agri strength, but also it can make a difference to the agriculture. It can really make a big difference in transforming agriculture and improving farmer income. So that's where I'm more excited about.
Just staying with the agribusiness, and I just wanted to get a clarification from you on what's happened on the export front because of the restrictions. What was the revenue contribution on the export side, and what is it today? And secondly, you also spoke about commissioning new plants. What is the capex likely to be? These are, of course, already plants that are going to be commissioned. But in terms of new capacity being added on, what is the capex outlook?
Okay. So as far as the revenue is concerned, I think the large surge in our revenues that you saw in the recent past has been driven by some of these opportunities. No doubt about it, right? But these are really trading opportunities, right? And trading opportunities also are not, these are small margin opportunities, right? We are not speculators. We only trade, you see, when the opportunity arises, right? And because we have the infrastructure across states, fundamentally what we focus is on what I spoke to you about, right? So it's a large percentage in revenue, but we will try and grow the value-added piece, and there are many vectors in that. It is spices, it is coffee, it is aqua, it is fruits and vegetables. We're also developing...
But in the near term, there will be a significant hit if it is a large percentage of the revenue on the export side.
Yes, but what I'm really trying to say is, as far as exports are concerned, this kind of opportunistic exports are concerned, they come with very wafer-thin, they come with wafer-thin margin. It's not something that is going to materially, change the... They will be blip in the top line, but it does not give you commensurate bottom line. So just we have to keep that in perspective, right? Okay. As far as capex is concerned, for replacement and upgradation of technology, as also growth capex, what we are saying is we'll probably be at a group level will be about 3,000 crores a year. And 70% of this is likely to be in FMCG and the paperboards business. 30% will be in other sectors. So both combination of growth capital and renovation and upgradation and modernizing of plants, etc.
Let's talk about some of the individual verticals, and I'll start by talking to you about hotels, because here we are at the ITC Moria in the capital. The question of the demerger is back on the table, and from our last conversation you had said it's not a question of if, it's a question of when. Are you any closer to answering the when?
Well, I was waiting to see when you would ask me this, because I've answered this so many times that I'm sure your viewers will also be bored at hearing the answer. What I have to say is really what is there.
Is it still the same?
Same answer, what is there in our annual report and what I said at the AGM, right? When there is any material development beyond that, you will be amongst the first to know.
So you're nowhere further away from or closer to being able to take that decision today?
Well, I'm saying when there is any further material development, you'll be amongst the first to know, right? As of now, that position is there. It's very much on the table. That's what we have said in the annual report.
Yeah.
That it's very much on the table. When there is anything more to report, we'll certainly do that.
So let me get a quick pulse check on the hotels business, since since there is no further clarity on the demerger. In terms of adding rooms, in terms of the bounce back that we are seeing as far as the hospitality sector is concerned, what's the outlook for the hotels business from here on? How confident do you feel?
So I think the performance of the hotel business, as you've seen in the recent past across the industry, has been very good. In fact, we've never seen this kind of performance for a long time. So it is good. And in the first quarter, if I would say, it was both a combination of revival of business travel, leisure, weddings, and of course there was some pent-up demand. But the international travel, I would say, was still muted. Business travel was still had not reached the pre-COVID level. So that is getting back. International travel is also improving. And we do not see much supply coming in.
Okay.
Right. So therefore we are quite optimistic on this segment. And we had said, I had mentioned to you earlier that our strategy, is going to be asset right.
Yeah.
And to further that, we also launched 2 brands in the recent past, Story and on Momentos. Right. We already have two stories have been launched. Momentos also should start. In fact, in the last, the period since the pandemic, we've opened 14 properties. Three were our own, which we had started construction some time back, and 11 are managed properties. And going forward, the target that we have set for the hotels business is we must at least do 1 property a month. And we are getting good interest amongst owners of assets in India. And also there is interest beyond the Indian borders, which we are starting to explore.
Okay.
And really the target is to do 1 a month, so we are quite buoyant.
In terms of adjacencies, in terms of new launches, in terms of new verticals, what is the thought process at this point in time? Do you have enough on your plate, or are you looking at making some new fresh bets?
Okay. So it's a combination. But it's actually completely sticking to our strategy and principle, where we say that we will play in segments where we can leverage enterprise strengths. And we've also said that digital and sustainability are going to be mega trends of the decade. So anything that is linked to digital and sustainability and where enterprise strengths can be leveraged, it's on for us.
Okay.
Right. So there are 2 that are already in the play. There's a 3rd that is almost baked, so I'll tell you in the near future. Okay. The 2 that are one is I spoke to you about is ITC Mars.
Nice, right.
The second is sustainable packaging, where we are getting, we already have a range of products in the market, but I would say these are the simpler solutions. The little complex one, a lot of developmental work with internally and with global collaboration is in the pipeline.
Okay.
And besides that, of course, this whole principle within the FMCG vertical is really about scaling mega brands, using mega brands to address adjacencies, and developing new categories for the future. So that is ongoing, right? So what is happening there is that brands like Ashirwad and Sunfeast and Bingo, these are being scaled up. We already have about 6 brands which are up in the 1,000 crore plus club. Ashirwad is 7,500 crores, Sunfeast is 4,500 crores, and we're using that to address adjacencies, because even in our whole addressable market with our portfolio is about 5 lakh crores, has been estimated some by analysts, the highest in the FMCG space, I would say. Now, there is huge headroom to grow by penetration, and given the per capita levels of consumptions, even branded atta, for example, quarterly penetration is only 32. If I go to something like dark fantasy chocofills or the dark fantasy range, it would be low single digits, right? So huge headroom to grow by penetration.
Right.
So whilst we are driving that for Ashirwad, we're also addressing new customer segments by getting into millet-based products under ITC Superfoods, organic. We're also getting into gluten-free, specialized offers, sugar release control. You
said that you've already got 6 brands. You named some of them that have crossed the 1,000 crore rupee milestone. How many more in the portfolio that are close or closer to the 1,000 crore milestone?
There are some more. There are some more. So we should add on to the club. Hopefully next year we should add on to that club some more. Yeah. Maybe a couple of them.
Okay. Yeah. A couple of them will get added onto the 1,000 crore plus club, as you said. But I just want to understand from you at this point in time, what we are seeing, and we're seeing large FMCG companies like yours, and you've done some as well, go the D2C route by way of acquisitions. How actively are you looking at the acquisition route to be able to fulfill getting into some of the adjacencies or some of the newer markets that you spoke of?
So it's like this. Let me say that I believe most categories are ultimately going to be omni-channel. D2C brands have developed some interesting propositions which are good to build on the D2C platform, right? Unique spaces, and some of them have very interesting ideas. So the spaces that are of interest to us, like mother and child, right? We will invest. We've done Mother's Purse, we've done Milo. So we are right now, of course, a financial investor. And as and when, the founders wish to divest and there is an opportunity and it is working out well, we have the option of, acquiring it. And that's something that we are looking towards doing. In the meantime, of course, we work with the startups and help them, provide them access to some of our institutional strengths that can help them scale up faster and accomplish their objectives. So we are certainly looking at this actively. At this point, we are in discussion with another brand in that space.
Okay. In the mother and
child space.
Okay.
So that's not the only space. There are some spaces we have identified. We have, and we would like to go that route, because these platforms have developed some unique propositions, and they also come really, and we have to acknowledge, they come with superior tech skills, right? Whilst legacy companies like ours are good at distribution, good at brand building, good at product development, and we are all aggressively pursuing a digital agenda, but we have to acknowledge the tech startups are certainly ahead of us as far as
the tech is concerned.
As far as tech is concerned.
Yeah.
So that also gives us an opportunity to, learn and bring in some of those practices in-house. Having said that, we will also do D2C on our own, and there are certain propositions which I think are really suited to D2C. For example, Meri Chakki Atta.
Okay.
And we've also got something like myclassmatesshop.com,
right,
where you can personalize your, so personalization solutions will have to be enabled through a digital ecosystem.
Sure.
We've also got our D2C on Derma-free kits in the recent past.
Right.
So we will be doing selectively on our own, whilst we will also watch this space, because there are interesting, offers available and options available in that space.
We haven't spoken about the cigarette business, so let me ask you about the cigarette business now. In terms of volume growth, the expectation is that, you've seen a volume growth of between 7 to 9% quarter on quarter, and things have been stable, at least on the tax front, and there has been no surprise, a nasty surprise for you on the tax front. So what's the outlook as far as the cigarette business is concerned at this point?
So, as you know, we don't give guidance. So I will refrain from, as a policy, we don't do it. So I'll refrain from doing that. Let me put it this way, that given that the economic activities have normalized and the macros are stable, what we have seen in the past is that in such a situation, and let's remember that legal cigarette industry is only 8% of the tobacco consumed in the country. It's just 8%, right? Balanced is illicit or other formats, right? So we have seen that in situations like this, and that there is past data to show it out, the legal industry is able to claw back some volumes from the illicit trade, and I would say we are seeing some green shoots of that, and based on the past data, and it has happened many periods of time, I think that trend that trend has been demonstrated in the past. So one can only hope for that kind of trend to kind of continue. And it's good that, I'm glad that the government also is cognizant of the menace of illicit. To a fourth of the industry, cigarettes is illicit. So stability along with enforcement actions, and you must be reading about it almost every day on some seizures. I think it's certainly helping the legal industry to claw back.
Let me then ask you, at this point in time, you talked about belt tightening, and you said that you haven't tightened the belt as much as you have over the past year or so. How much more are we likely to see in terms of that? And, how worried are you about margins today? What would you qualify as the big risks, both to the demand outlook as well as the margins today?
I would think inflation is the big risk, because it's both on the energy side and on food. So that is the real risks as far as both margins and demand environment is concerned. Having said that, I think we should acknowledge the fact that the Indian government has managed the situation much better than how it has been managed globally. I think I would say we are much better placed. We are not isolated from the rest of the world. But we are managing it much better. So, but this is clearly a monitorable. The second monitorable is, of course, with the recession that is, at least in Europe, and it could happen in other places, that can also mute export. We are also hearing those signs. Yeah. And that, would have its impact on the economy. So that would be the second order of risk, I would say. But, we are once, inflation the spikes in inflation normalize. It is not at the abnormal levels that it's been in the past. I think we believe we still can continue to improve margins through a lot of interventions that we are doing. It's, for example, through digital. The way we buy today, Industry 4.0 in the factories, in the supply chain, all facets are being optimized through digital technologies, and we are seeing benefits of that. Our distributed manufacturing of ICMLs, we have 10 of them now, and 2 of them already have integrated automated warehouses, which gives another productivity in logistics, right? So all of this with reduced distance to market, with the delayering of operations and the optimization efforts that we are taking, continuing to boost usage of renewable energy. So all that is, with that we do believe that the 1% or 100 basis points that we are talking about consistently improving margins year on year, I think we will be able to deliver it.
Okay.
I mean, this the last year and this year, I mean, we've not been able to do that simply because the level of inflation has been unprecedented. Yeah. So once this normalizes, I think we'll be back on track as far as that is concerned.
So let me end then by asking you, any changes to the org structure at all? There's been a lot of rumors about the possibility of splitting the chairman and the CEO's position. Is that on the cards? Is that being considered in any form or fashion at all?
I haven't heard this rumor. I haven't heard this rumor. There's been no talk as far as ITC is concerned, but I don't know where you picked it up from.
Well, I thought it's best to have you address it, but you believe that the festive season at this point in time, all indications that it's likely to hold up in terms of demand?
Yes, absolutely.
Sanjiv, always a pleasure. Thanks very much for joining us here on CNBC TV18. Appreciate your time, and thanks very much for joining us on The Record.
Thank you. Thank you, Shereen, for having me. Always a pleasure.
With that, it is time for us to wrap up this edition of On The Record. From all of us here on the team, goodbye. Thanks for watching. Stay tuned to CNBC TV18. The news continues.